Hey everybody, this is Brant, and we're going to do a quick little look at the market. So, really dull week, and the S&P 500 right over here, just down 0.1%. Nothing was up or down more than 0.6%. NASDAQ down 0.6%. IWM small caps up 0.6%. But generally speaking, a really dull week. So let me just show you why coming into this, or why I think. So here's our rally starting off the October lows, and in this trend you can see higher highs, higher lows over here right until we get into this measured move target, which was actually 4150. It came from the base over here. S&P actually just came a little bit shy of 4200. So as we come into earnings season right over here, we're stuck right below that 4200 or that February high level. Now, it's not unusual for earnings season to be kind of dull in terms of trade, especially in the early part of it. And earnings season just kicked off last week, so we're in the early part of it. Until there's like a composite picture of what earnings are looking like, yeah. So we can have a little bit dull trade like we saw this week, but there's other things too. You've got some technical resistance right over here. You've got people who are taking money out of the market to pay taxes. And some of the economic data that we've gotten so far has been kind of similar to February. February, we got a lot of hot data that made the Fed uncomfortable. Inflation looking a little hotter than it should. So we're starting to get a few of those reports. Not as many as consistent as February over here, but we are seeing some of those. So it's obvious traders and investors have kind of low conviction here. So starting with the S&P, let's take a closer look, 15-minute chart. This was a bullish ascending triangle. Looked like a bull flag over here for a little bit. This is not the kind of breakout you want to see, but it is holding up here. So I don't have a strong feeling that this is like a head fake or a failed breakout yet. I just think it's just bad timing coming into earnings season. But in any case, holding up here at the bottom of this trend line. So if it breaks below that, breaks below 4100, then yeah, I'd be a little bit more concerned that this is a bull trap and failed breakouts lead to fast reversals. On the hourly chart, you can see that resistance area just below 4200, but this is what we're kind of running into over here. Overhead supply from February. And if we take a look at the daily chart real quick, this has pretty much been my forecast since like summer of last year that we would transition from a bear market or a primary downtrend to an intermediate trend lateral market, which is kind of what we have here. You can see it a little bit more in small caps, but this is what I was looking for back here around August, and that's what we have right now. Looking at a 4-hour chart of the Dow, remember it was the first one that put in a really strong kind of W bottom right over here, and the Dow rallied 20%. At the time, people were asking, is the Dow a new bull market? I said, no, I don't think it is. In any case, done nothing since then, but this large symmetrical triangle. Usually these are consolidation patterns, but the bigger they get, the more likely they are to be like tops. So a 3-week consolidation pattern is fine, but a 2.5, 3-month consolidation pattern, that's looking toppy. So you can see that Dow broke down, and now we're coming into resistance right here at this apex of this triangle here for the Dow. Here's a 30-minute chart of the NASDAQ 100. I'm not quite sure what to call this consolidation. Maybe it's like a rectangle or something, but there is this kind of lateral consolidation. And if you look at the price action in the NASDAQ, remember it rotated in of Q1 this year, provided leadership. It had its own 20% gain in Q1. Look, a lot of bull flags, and this is coming out of a bigger bull flag. Here it is on an hourly chart. And if there's one thing the NASDAQ did do that S&P didn't do, it made a higher high relative to that February high where the S&P is kind of hung up right now. But that is not to say that we don't have some resistance in play for the NASDAQ 100. So if you look over here, you can see where this kind of rally ended and a gap down, and that's kind of the zone of resistance that we're in right now. So a lot of the averages, when you get a more lateral trend like we've seen, intermediate trend, you get a lot more of these like support and resistance levels everywhere. Here is a 60-minute chart of small caps IWM. They have a lot of exposure to the regional banks. So remember that little mini banking crisis we had with Silicon Valley Bank. Here we can see that drop. Now it is interesting what's going on here. So let me just put some trend lines on. To me, this looks like possibly an inverse head and shoulders base. If we look at the volume, what you will see is pretty good volume, or what we would expect to see on a head and shoulders, inverse head and shoulders. So bigger volume on this right shoulder, as you can see here, and then usually the volume tops out like a capitulation event right over here, and you can see that high red volume. Now, the next thing you want to see is volume expand a little bit on this rally, which we can actually see, but we want to see it expand even more over here on this rally, and we don't get so much of that. So it's not a perfect pattern. This is really dependent on what goes on with the regional banks in this earnings season. Generally speaking, I think we still have pretty good price action. And one of the ways I can tell when a market is like turning either from a bearish trend to a bullish trend, or a bullish trend to a bearish trend, is just by watching the price action. So remember, I showed you the NASDAQ 100 and all of those bull flags. We've got a bull flag over here, we've got a bull flag over here, we've got a bull flag over here, and it's all coming out of this huge bull flag over here. So you'll see a lot of bullish price action. But what I'm seeing lately, there's still some bullish price action, enough bullish price action, but there's also some weakness starting to develop. My thought has been that we would probably rally into the first quarter, into maybe part of the second quarter, but kind of thinking like sell in May and go away. Next week, the mega caps are going to be front and center with earnings. So let's take a look at the mega cap index. And remember, the mega caps are what rotated in Q1 of this year. So before that, the Dow led the rally. Then it was the NASDAQ 100 and the mega caps for the first part of Q1. Now we're in Q2, and it's like, what's going to lead now? Well, I think there's still upside for the mega caps. They still look pretty good. I am watching small caps and those regional banks, but here we go. This is the mega cap index, 300 growth index, MGK. And as you can see over here, we have a bullish ascending triangle. So it's acting pretty good. It's respecting these trend lines. A couple little pokes here and there, but nothing big. If we go to like a 60-minute chart, you can really see the bullish price action. So here it is, big bull flag as that February data came in hotter, and then we rally. So again, unlike the S&P 500, it rallies above that February high. We do have a bullish pattern right here. And a lot of times, like, this is the first leg up, this is the big consolidation, and then when it breaks out over here, you expect a second leg up. Now, what happens a lot of the time is in the middle of that second leg up, about halfway, you'll get a smaller consolidation. So that may be what we're dealing with here. I still lean towards the mega caps over most everything else. IWM, the small caps, and the regional banks on a very speculative basis. And let's take a look at some of those sectors. Let's go with the tech sector because it's the most influential. So again, big bull flag, advance, bull flag. This is a consolidation continuation pattern. So it says that we are going to continue this uptrend, this preceding uptrend. And we start, and again, about halfway through it, we get into another smaller consolidation, which looks like another bull flag. Not all of the mega cap heavy indexes, or sectors rather, look like this. Communications is heavy with mega caps. It does not look as good. You can see it has not surpassed this February high over here. So this is why I'm saying I am seeing some stuff that's kind of deteriorating a little bit, but I wouldn't say let's go all out bearish yet. But I do see some stuff that is kind of weakening a little bit. This could be interesting next week because a lot of the mega caps are reporting. As a matter of fact, I think next week has like 45% of the S&P's market cap is reporting earnings. So it's a big week next week. And then we have the May 3rd FOMC decision. So that is going to be another really big thing to watch out for, and probably why this market is a little bit more cautious or lower conviction. So the big question is, does the Fed hike rates in May, or do they pause? So I'm of the opinion, actually the market is of the opinion, that they are going to hike rates. We got strong PMIs this week that were a little bit inflationary, and that basically sent a 25 basis point rate hike to almost a certainty. But what I do want to show you, and I've shown this before, I just want to go over it one more time again. The bond market is telling the Fed it's time to stop. So what I have up here is the effective federal funds rate. So that is in blue, and then the 2-year yield in red. So what I've noticed, and it's not every time, but it's more often than not, when the Fed is in a rate hiking cycle like this, and the 2-year yield crosses below the Fed funds rate like this, what happens? The Fed pauses that rate hike cycle, and then they eventually cut. So this is going into that tech bubble, okay, the recession. This is recession shading. So that's the early 2000s. Here we are in 2005, 2006, coming into the financial crisis. That's what this gray recession shading is. There's the Fed funds rate. Again, the 2-year yield crosses below it. The Fed pauses their rate hike cycle and then eventually starts to cut. So when you see that 2-year yield cross below the Fed funds rate, it's telling you something. The bond market is telling the Fed something. And here's another example going into the COVID lockdown crisis. That's the recession over here. You can see the Fed was hiking rates and then the 2-year yield crossed below. The Fed stopped hiking rates and then started cutting rates. So now what do we look like? Here is the Fed funds rate on this latest rate hiking cycle. And here's the 2-year yield. So it has crossed below the Fed funds rate. So that tells us that there's a pretty high probability that the Fed is going to pause very soon. The market does not think it's going to be in May. So the market is pricing in a 25 basis point hike, but I think that might be the end of it. And what my whole theory has been from the start is that the market would rally into peak inflation and peak Fed hawkishness, which was really coming from that rally from October lows of last year, which is still in effect. But I have a feeling that when the Fed actually does pause rate hikes, it's going to kind of be a situation like buy the rumor, sell the news, if that makes any sense. And we'll also be moving into a seasonally unfavorable time of the year for the market, which is May. You might have heard sell in May and go away. And then the summer tends to be kind of a weak time for the market seasonally. As far as that inflation data goes, let me pull up a couple things real quick. There's a lot of different measures of inflation, but this is CPI. So actually, no, this is the PCE index. Here is CPI on a year-over-year basis. And I think that we can probably say that we have seen peak inflation over here and it's starting to roll over. But just like any trend, you get noise in that trend. And this is not the only measure of inflation. What the Fed does not want to see is a Volcker-like mistake from back here in the early 80s. They don't want to see resurgent inflation, and that was a big problem over here. So Volcker had gotten inflation to start to go down by raising the Fed funds rate to, 18 or 19%, something crazy back then. And then the economy went into recession, and that's what it should do. That helps bring down inflation. And he got some political pressure to start cutting rates. He did, and inflation ramped back up. So that's what the Fed is terrified of, is that inflation will ramp back up. Over here, you can see the Fed's preferred measure of inflation, which is the PCE index on a year-over-year basis. So you can see inflation here very strong, but now it's getting toppy. But like I said, when you're kind of turning in a trend, it's like that old saying, the trend is your friend until the end when it starts to bend. So you will get this kind of choppy stuff, and you will see like little peaks in inflation here, and then it'll come down. But I think that's probably what we're dealing with right now with some of the hot data that we've seen so far this month. It's not as consistent as February, but it's definitely something that is going to play on the Fed's mind in this early May meeting. It looks to me like the bond market is saying, look, Fed, you're done with the rate hikes. But again, the Fed is terrified of making that Volcker mistake. For the market, this could be very challenging because if we do get resurgent inflation, and there's a couple assets, commodities I've been watching just in case their price action has been kind of like right on the edge of going in that direction, but hasn't. So if that happens, it's like throw everything out. Everything the market's priced in about what the Fed is going to do and all of that, throw it all out and we'll start from scratch. So it would be a big, big deal. Let me just cover gold and Bitcoin real quick. And what was it, last week or the week before? I did like on YouTube, they have these shorts. They're 1-minute videos. And I did 4 of them on Bitcoin and what I thought it would take to move Bitcoin. And Bitcoin has been moving a lot like gold with actually like a 7-day lag. But in any case, let's go to gold first. So this is an hourly chart of gold futures. This is a nice bullish ascending triangle, and there's a breakout with nice volume here. My opinion, and I said this, I think probably the day it broke out, was I think it broke out too early. What I think gold and Bitcoin have been representing as they move higher is the probability that the Fed stops tightening policy. They stop letting their balance sheet run off. So a lot of the gains over here were when the Fed's balance sheet actually expanded because of the little mini banking crisis. But in any case, when you get a breakout like this, it should be really strong. It tests 2,000 again here. I did not like that. It made a higher high, tested 2,000 again. Did not like that. 3-4 times it closed under 2,000 Friday. So this is not the way gold should be acting, breaking out from a bullish consolidation like this. But like I said to my members or subscribers, I think it broke out too early. Now, what's really interesting is gold seems to be leading Bitcoin by about 7 days. So if you look at this initial consolidation, ascending triangle, the initial breakout, and then a test back deeper than it should be, watch what's happening with Bitcoin. Let me move to that chart. And here's Bitcoin futures on an hourly chart. Look familiar? Bullish ascending triangle, breakout. It does not pull back to this level, but it pulls back further. Matter of fact, I said in one of my daily wraps for my members this week, I said for Bitcoin to kind of follow in gold's footsteps, I think it would need to pull back to about 28,000, which is not great for the price action. But it actually went a little bit below that. So Bitcoin is kind of tracking gold with about a 7-day lag, and I think they're representing the same thing. There was this initial view that the Fed is going to stop tightening policy very soon, and I think these got a little bit ahead of themselves, quite frankly. If you do watch those quick 4 1-minute video shorts on Bitcoin and what's going to move Bitcoin, I talk about the Fed balance sheet. I show what's happened with the Fed balance sheet. So let's take a quick look at that. And here we are. So this, if you watch those 4 1-minute shorts, this is liquidity going in. This is the Fed's balance sheet expanding, and that was banks pulling money from the Fed after that little mini crisis. But we've had the balance sheet kind of come down, and we've seen gold and Bitcoin's price action not acting so great as this has happened. Over the last month, that's about $140 billion that's rolled off the balance sheet right over here. And that's where we see, gold and Bitcoin starting to get hung up. So as we move forward into next week, and just generally speaking, some of the things I'm watching for, of course, next week is going to be huge for mega cap earnings, and like 40% of the S&P's cap is going to be reporting earnings next week. So that is big. Watch those regional banks. Regional banks actually broke out of this little interesting pattern, a little basey-like pattern, not quite as nice as IWMs or as interesting as IWMs or small caps. But in any case, they outperformed on the week, even though we did get some good earnings from a couple of the regional banks, and then we got some bad earnings and the price came down again. But still, I think the regional banks were up 1% on the week, whereas the S&P was down 0.1%. I think you have to watch this dollar index. The dollar index has had, US dollar index, has had an inverse relationship with stocks since the end of the COVID crash, okay? It's been reflecting basically Fed policy. So the dollar higher is the Fed tighter. The dollar coming down lower has been expectations of peak inflation and peak Fed hawkishness. That doesn't mean they're going to rate cuts, but they've made their peak rate hike, those 75 basis point hikes, and now they're coming down, stepping down. But what's interesting is that we have this little kind of double bottom, I guess you would call it. And if we start to see the dollar take off, that is going to hit stocks. And that is also going to suggest that maybe that inflationary data is coming in stronger than expected, and it's moving expectations for the Fed to be a little bit tighter than is currently priced in. Now, conversely, if the dollar breaks down below that, it should be supportive of the market in this little rally that we've got going from October to continue a bit longer. These are the regional banks. This is one thing I'm watching real closely because this yield curve tends to lead them. So we saw sharp flattening of the yield curve for almost, it was actually over a month, and then these banks just caught down in 3 days with the SVB failure. But now we have steepening, so it's actually leading the banks a little bit higher. I think there's a potential for a relief rally here, but it's kind of like catching a falling knife. It's a little bit of a tricky trade. These mega caps that are going into earnings next week in a bullish ascending triangle, I think that's pretty interesting. So I'd be watching these closely. I think these still look pretty darn good. They did really well in Q1. They blew everything away. Now we're in Q2. We haven't really seen which way everything's going to rotate, but we still have bullish price action in these mega caps. So I'd be watching these next week. And ultimately, the S&P needs to clear this February high, or basically clear 4,200 for this rally to have more legs. But this is a tricky spot right now because there's overhead supply, there's the uncertainty of earnings, there's the Fed coming up. A lot of things have all converged at once to kind of take conviction out of investors, and just has made for a very dull market the last couple weeks actually. But 4,200 for the S&P is key. One other quick note, Friday, just this last Friday, we had $1.9 trillion in notional of options roll off. So that gamma should unclench, and instead of seeing this really dull, tight price action, a lot of days this week, the market averages were, the major averages were like 0.1% up or down, like nothing. So that should unclench, and we should see prices start to move a little bit more freely next week as we go into those mega cap earnings. But there's a lot coming up, a lot on the table, and I hope you guys come back and tune back in. Maybe consider subscribing to the website, and you get all this stuff in real time as it happens multiple times throughout the day. Other than that, have a great weekend, everybody.